Welcome to Retirement Investing 101 channel, where we simplify your financial future. Our mission is to guide you step by step towards smart, stress-free retirement planning. Everyone dreams of a comfortable, stress-free retirement. Traveling, hobbies, time with family, whatever your version of the good life is, it runs on one thing: money. But when you actually look for advice on how to get it, you're hit with a wall of confusing jargon, complicated charts, and guides that seem written for somebody else. What if you're 25 and have no clue where to even begin? The whole idea of saving for something 40 years away feels abstract and, frankly, a little overwhelming. Or what if you're 55 and you feel like you're hopelessly, terrifyingly behind? You see the finish line coming up fast, and that little voice of panic is starting to get loud. The advice for the 25-year-old to just let compound interest work its magic feels like a slap in the face. Here's the truth. Most retirement advice fails because it's not personal. It doesn't get that the game plan for a recent grad is totally different from the one for someone just a decade away from clocking out for good. This video is going to fix that. This is the roadmap that speaks to everyone. We are going to break down the exact actionable steps for both a 25-year-old starting from zero and a 55-year-old who needs to make up for lost time. No more confusion, no more fear, just a clear, step-by-step plan you can start using today. My goal is simple: to give you the clarity and confidence to grab the wheel of your financial future, no matter where you're starting from. So, sit back. Whether you've got decades to go or just a few years, stick with me. This is the guide you've been looking for. Before we map out the specific paths for our 25-year-old and our 55-year-old, we need to build a solid foundation. There are a few core ideas in retirement investing that are true for everyone, no matter your age or income. Getting these is non-negotiable. It's the what and the why behind everything else we're about to do. First, and most importantly, let's talk about the single most powerful force in finance: compound interest. Albert Einstein supposedly called it the eighth wonder of the world, saying, "He who understands it earns it. He who doesn't pays it." Here's how it works. When you invest, your money earns a return. The next year, you earn a return not just on your original money, but also on the return from the year before. It's a snowball effect. Your money makes money, and then that money starts making its own money. Let's make that real. Say you invest $5,000. If it earns a 7% return, after a year, you have $5,350. The next year, you're not earning 7% on $5,000 anymore. You're earning it on $5,350. It seems small at first, but over decades, the difference is staggering. This is why starting early is so powerful. A 25-year-old who saves $500 a month could end up with a much bigger nest egg than someone who starts saving $1,000 a month at age 45, just because their money had more time to compound. This isn't magic, it's math, and it's the biggest reason to start now. The second universal principle is knowing where to put your money. I'm talking about retirement accounts. You've probably heard the alphabet soup: 401k, IRA, Roth IRA. It's confusing, so let's clear it up. These aren't investments themselves. Think of them as special savings buckets that hold your investments and give you huge tax advantages. The most common bucket is the 401k. This is the plan you get through your job. If your company offers one, this is almost always where you start. The money comes right out of your paycheck, often before taxes are taken out, which lowers your taxable income for the year. A nice little instant win. The money then grows tax deferred, so you don't pay any taxes on the growth year after year. You only pay income tax when you finally pull the money out in retirement. But here's the best part of a 401k. The thing you absolutely cannot ignore: the employer match. many companies will match what you put in up to a certain percent. For example, they might match 100% of your contributions up to 4% of your salary. This is free money. I'll say it again. It is free money. If you earn $60,000 a year and they offer that match, they are giving you an extra $2,400 a year. Not getting the full match is like literally turning down a raise. It's the best return on investment you will ever get, guaranteed. If you work for a nonprofit or in government, you might have a 403(b) or a thrift savings plan, TSP. For our purposes, just think of them as being basically the same as a 401k. Next up is the individual retirement account, or IRA. Like the name says, this is an account you open on your own. The two main flavors are the traditional IRA and the Roth IRA. A traditional IRA works a lot like a traditional 401k. Your contributions might be tax deductible. Your money grows tax deferred, and you pay taxes when you take it out in retirement. The Roth IRA, on the other hand, is a game changer, especially for younger folks. With a Roth, you contribute money after you've paid taxes on it. So there's no upfront tax break. But here's the magic. Your money grows completely, 100% tax-free. And when you take qualified withdrawals in retirement, that money is also 100% tax-free. This is huge. Imagine your account grows to $1 million. In a traditional account, you'd owe taxes on every dollar you withdraw. In a Roth, that million is all yours. Now, there are income limits. For 2025, you can contribute the full amount if your modified adjusted gross income, or MAGI, is under $150,000 as a single filer, or under $236,000 if you're married and filing jointly. If your income is a bit higher, don't sweat it just yet. There's a phase-out range where you can still make partial contributions, which goes up to $165,000 for singles and $246,000 for married couples. So, to recap the buckets: 401k, job-based plan, get the match first. Traditional IRA, your own account, tax break now, pay taxes later. Roth IRA, your own account, no tax break now, but tax-free money later. Now, we know why we invest, compounding, and where we invest, accounts. The next piece is what to invest in. This is where people get paralyzed. Stocks, bonds, mutual funds, ETFs, what does it all mean? Let's keep it simple. For 99% of us, you don't need to be a stock-picking genius. You just need to know two basic investment types. The two building blocks are stocks and bonds. Stocks. You're buying a tiny piece of a company. If the company does well, your piece becomes more valuable. Stocks have higher growth potential, but also more risk. Bonds, you're lending money to a government or a company. They promise to pay you back with interest. Bonds are generally safer, but offer lower returns. Your asset allocation, your mix of stocks and bonds, is what really drives your portfolio's results. A younger person will own more stocks for growth. An older person will own more bonds for stability. So how you buy them? You could buy individual stocks, but that's risky. If that one company tanks, you lose big. The key is diversification. You want to spread your money across hundreds or thousands of companies. This brings us to the most beginner-friendly ways to do that: index funds and ETFs. Index funds. This is a type of fund that doesn't try to beat the market. It just tries to be the market. It passively tracks an index, like the S&P 500, 500 of the biggest US companies. Because nobody is actively managing it, the fees are incredibly low, which saves you a fortune over time. For most people, a simple, low-cost index fund is the single best way to invest. ETFs, exchange-traded funds. These are a lot like index funds. They also track an index and have low fees. The main difference is they trade like stocks. so their price can change throughout the day. And for the ultimate hands-off approach, there's the Target Date Fund. This is an all-in-one retirement solution. You pick a fund with a year in its name that's close to when you plan to retire, like a Target Date 2060 fund. It automatically holds a diversified mix of stocks and bonds, and it adjusts that mix for you over time, getting safer as you get closer to 2060. It takes all the guesswork out of it. The final principle is automation and consistency. The real secret to building wealth isn't timing the market, it's time in the market. You have to make investing a habit. The best way is to set up automatic transfers from your paycheck to your 401k, or from your bank account to your IRA every month. This is called dollar cost averaging. You invest a set amount regularly, no matter what the market's doing. When prices are high, you buy fewer shares. When prices are low, you buy more. It smooths out the ride and removes emotion from the process. Master these principles, and you're already way ahead of the game. All right, let's talk to the 25-year-old. You're starting your career, and retirement feels like a different lifetime. You're probably juggling student loans, rent, and trying to have a social life. Saving for your 65-year-old self is likely the last thing on your mind. But here's the deal. You have a superpower that no 55-year-old, no matter how rich, can ever get back. That superpower is time. With 40 years until retirement, compound interest is your best friend. Your goal isn't to be cautious. Your goal is aggressive growth. You have decades to ride out market ups and downs. A market crash in your 20s isn't a disaster. It's a fire sale. It's a chance to buy everything on discount. So let's build your roadmap. Step 1, build your financial foundation. Before you invest $1 for retirement, you've got to get your financial house in order. This isn't the sexy part, but it's the most important. First, you need a budget. I know, the word sounds awful. Think of it less as a restriction and more as an awareness plan. You just need to know what's coming in and where it's going. Use an app, a spreadsheet, whatever. Just track your spending for a month. You will be shocked at what you find. That awareness is step 1. Second, attack high-interest debt. I'm talking about credit cards, personal loans, anything with an interest rate over 7-8%. Paying off a 22% interest credit card is like getting a 22% guaranteed risk-free return. No investment can promise you that. Get aggressive and pay it down. Third, build an emergency fund. This is non-negotiable. It's 3 to 6 months of essential living expenses, parked in a high-yield savings account, safe and easy to get to. This isn't an investment. It's your financial life insurance. It's the buffer that keeps a car repair or a layoff from turning into a total catastrophe that forces you to raid your retirement savings. Step 2, the account funding waterfall. Once your foundation is solid, it's time to invest. We're going to use a simple waterfall strategy. You fill one bucket, then let the money spill into the next. Bucket number 1, your 401k up to the full employer match. Your first priority, no questions asked, is to contribute enough to your 401k to get the full employer match. Again, it's a 100% return on your money. Don't leave it on the table. Bucket number 2, max out a Roth IRA. After you snag the full match, your next dollars should go into a Roth IRA. Why? Flexibility and that sweet, sweet tax-free growth. You're probably in a lower tax bracket now than you will be later in life. It makes way more sense to pay taxes now with a Roth than later in retirement when you're earning more with a traditional. For 2025, the max you can put in is $7,000. Make it your mission to hit that limit. Bucket number 3, go back and max out your 401k. If you've gotten your match, maxed out your Roth IRA, and you still have money to invest for retirement, first off, you're a rock star. Go back to your 401k and contribute as much as you can, up to the federal limit. For 2025, that's $23,500. This is how you supercharge your savings. This waterfall strategy, Match, Roth, Max, is a proven way to optimize every dollar you save. Step 3. Keep your investments simple and aggressive. So, what do you buy in these accounts? At your age, complexity is your enemy. You don't need 20 different funds. You need simplicity, diversification, and low costs. Your asset allocation should be aggressive. Think 80-90% stocks and 10 to 20% bonds. Here are 3 great simple options. A target date fund, the easiest choice. Pick one with a year near your retirement, e.g. 2065, and put 100% of your money in it. The fund does everything else. It's the ultimate set it and forget it option. A simple 3-fund portfolio. Want a bit more control? Build your own portfolio with 3 low-cost index funds. A U.S. total stock market fund, an international total stock market fund, and a total bond market fund. A good mix might be 55% U.S. stocks, 35% international, and 10% bonds. A single S&P 500 index fund, the simplest of all. Just invest in an index fund that tracks the 500 biggest U.S. companies. It's an incredibly effective, low-cost strategy that has built fortunes for decades. See the theme? Low-cost index funds. Keep your fees low, and you keep more of your money working for you. Step 4. Automate everything and ignore the noise. Once you've picked your accounts and investments, automate it. Set up the contributions from your paycheck and your bank account. Do it once, and the habit is built for you. Now for the hard part. Leave it alone. The news will scream about crashes. Friends will brag about some hot new stock. You will be tempted to tinker. Don't. You're a long-term investor, not a day trader. Trust the plan. The less you check your portfolio, the better you'll do. Your mission is simple. Save consistently, invest aggressively in low-cost funds, and let your 40-year timeline do the heavy lifting. Follow these steps, and you'll wake up in your 40s and 50s with a nest egg that will blow you away. Now, let's shift gears and talk to the 55-year-old. You're likely at the peak of your career, but retirement isn't some fuzzy dream anymore. It's a blinking light on the horizon. And maybe when you look at your savings, you feel a knot in your stomach. Life happens. Kids' college, medical bills, career changes, and retirement saving took a backseat. You're worried it's too late. Let me be very clear. It is not too late, but your strategy has to be different. You don't have a 40-year runway. Your superpower isn't time. It's your income and your focus. Your goal is a balancing act. Strategic growth, protecting what you have, and squeezing every drop out of your savings advantages. This is your decade of action. Step 1, the brutally honest financial audit. Before you can chart a course forward, you need to know exactly where you stand. This calls for a brutally honest financial audit. No judgment, just data. First, calculate your net worth. List your assets, savings, retirement balances, home equity, and your liabilities, mortgage, loans, debt. Assets minus liabilities is your number. Second, get real about your retirement spending. How much do you actually need per year to live the life you want? Don't guess. Track your spending now to project forward. Be detailed. Factor in healthcare. It's a big one. The 4% rule in reverse is a handy shortcut. Take your desired annual income in retirement and multiply it by 25 to get a rough nest egg target. Third, project your retirement income. Go to the Social Security Administration's website and get your benefit estimate. Do you have a pension? Other income? Add it all up. Now you can see the gap. The difference between the nest egg you need and what you have plus other income. That gap is your new goal. This can be scary, but clarity is power. Step 2. Become a super saver with catch-up contributions. Your peak earning years give you the firepower to save like never before. The IRS created catch-up contributions for this exact reason. Once you turn 50, you can save way more in your retirement accounts. You have to take full advantage of these. Here are the 2025 numbers. 401k, 403b. The standard limit is $23,500. But if you're 50 or over, you can add an extra $7,500 for a total of $31,000 a year. The new Super Catch-Up, thanks to the Secure 2.0 Act, starting in 2025, this gets even better. If you're 60, 61, 62, or 63, you can contribute an even bigger catch-up, bringing your total potential 401k contribution to an incredible $34,750 per year. Traditional Roth IRA, the standard limit is $7,000. The catch-up for those 50 and over is an extra $1,000 for a total of $8,000 per year. If you're married and both over 50, you can both do this. That's how you close the gap. It will require sacrifice. It might mean cutting back or delaying big purchases. This is the time to make your future self the #1 priority in your budget. Step 3, reevaluate and de-risk your portfolio. Your investment strategy has to change. You still need growth to beat inflation, but you can't afford the same risk as a 25-year-old. A major market crash right before you retire can be devastating. It's time to shift from a 90-10 stock bond portfolio to something more balanced, like 60-40 or even 50-50. This doesn't mean you sell all your stocks. Your retirement could last 30 years, so you still need that growth. But you're dialing down the volatility to protect what you've built. How do you do it? If you're in a target date fund, the fund is already doing this for you. Just make sure you're in the right one. If you manage your own portfolio, you'll need to rebalance by selling some stock funds and buying more bond funds to hit your target mix. You should also look at investments that generate income, like dividend-paying stocks, bond funds, and even real estate investment trusts, REITs. The goal is a resilient portfolio that can still grow, but is better cushioned from shocks. This is a great time to consider talking to a certified financial planner. They can help you build a plan tailored just for you. Step 4, pull your strategic levers. Saving more is only half the battle. You have other powerful levers you can pull. Delaying Social Security. You can take Social Security at 62, but your benefit will be permanently reduced. If you can wait until your full retirement age, around 67 for most, you get 100% of your benefit. And if you can hold off until age 70, your benefit will grow by about 8% for every year you wait. If you're in good health, this is one of the best moves you can make to boost your guaranteed income. Working longer, even 1 or 2 extra years, can have a huge impact. That's 1 more year of saving, 1 more year of growth, and 1 less year you need to draw from your nest egg. Or consider a phased retirement by shifting to part-time work. Mastering healthcare. If you retire before 65, you need a plan for health insurance before Medicare. It's a huge expense. Also, look into a health savings account, HSA, if you have a high deductible health plan. It offers a triple tax advantage. And if you're 55 or older, you can make an extra $1,000 catch-up contribution. The path for a 55-year-old is intense, but it's about a focused, comprehensive strategy. It is absolutely possible to build a secure retirement from here. We've covered a lot, but knowledge without action is useless. So let's boil it all down to 5 things everyone can and should do right now. This is your Kickstart checklist. 1. Investigate your employer's 401k match. Today, log into your company's HR portal and find out what is the company match. If it's more than 0 and you aren't getting all of it, your #1 priority is to fix that. Log in and bump up your contribution. Do this first. 2. Open an IRA this week. Everyone should have an IRA. It gives you more options and tax flexibility. You can open one online in 15 minutes at a major brokerage like Vanguard, Fidelity, or Schwab. Just go to their website and click Open an Account. Choose Roth or Traditional. For most young people, Roth is the way to go. Just get the account open. 3. Automate your first contribution. Right now, an empty account is useless. While you're opening your IRA, set up an automatic monthly transfer from your bank. Start with $50 a month if that's all you can do. The goal is to build the habit. Automate it so it just happens. 4. Choose one simple diversified fund. When you fund your account, don't get paralyzed by choice. Keep it simple with a low-cost diversified fund. Option A, easiest, a target date fund. Find the one with your retirement year and put 100% of your money there. Done. Option B, still easy, a broad market index fund, like a total stock market or S&P 500 fund. It's a fantastic, cheap way to own a piece of the whole market. 5. Schedule an annual financial checkup. Put a recurring event on your calendar for the same time every year called Financial Checkup. This is your time to review your plan. Can you increase your savings rate by 1%? Is your asset mix still right for you? It's a high-level review to make sure you're still on track. That's it. 5 concrete steps. Do these and you move from being a passenger to the driver of your financial future. We started this journey because for too many people, the path to a comfortable retirement feels like a mystery. My hope is that today, we've cleared away that fog. We've shown that the rules for success, compounding, tax-advantaged accounts, diversification, and consistency are for everyone. And we've laid out 2 clear, actionable roadmaps. For the 25-year-old, your greatest asset is time. Build your foundation, be aggressive, keep it simple, and automate everything. Your future self will thank you. For the 55-year-old, it is not too late. Your greatest assets are your income and your focus. Do an honest audit, become a super saver, de-risk your portfolio, and pull every strategic lever you have. The single most important takeaway is this: the best time to start investing was yesterday. The second best time is right now. It doesn't matter if you're starting with $50 or $5,000. What matters is that you start, that you take that first step from anxiety to action. The journey to a secure retirement is a marathon, not a sprint. And today, you've been given the map. If this guide was helpful and you want to go deeper on topics like specific funds, tax strategies, or withdrawal plans, make sure you subscribe. We're always putting out new content to help you navigate your financial journey with confidence. Thanks for investing your time with me. Now go take that first step.